Welcome back to another National Real Estate Exam Prep. And today we're going to talk about real estate finance. More specifically, we're going to go over 5 questions with their explanations as to why they are the answer. A loan fee charged by a lender to increase the lender's yield on a loan is a discount point. Discount points are fees paid upfront to increase the lender's yield profit on the loan. The yield is the difference between what it costs the lender to get the money and what the borrower pays in interest. Interest is the cost the borrower pays to use the lender's money. Principal is the original loan amount still owed, not including interest. The term of a loan is the length of time the borrower has to repay the loan. For residential loans, borrowers typically choose a term between 15 to 30 years. A longer term, like 30 years, means lower monthly payments, but more interest paid over time. A shorter term, like 15 years, means higher monthly payments, but less total interest. A lender that charges a rate of interest in excess over the permitted by state law may be guilty of usury. Usury is when a lender charges more interest than legally allowed. Fraud is an intentional lie or misrepresentation used to gain an unfair advantage, like tricking a borrower. Truth in lending violations happen when the lender fails to properly disclose true cost of credit, like APR, fees, or terms. Truth in lending law does not set interest rate limits. They only require clear disclosure. Which action is legally permitted? Refusing to make mortgage loans to a minority individual because of poor credit history. Bad credit is a valid reason to deny a loan or rental, even if the applicant is part of a protected class. However, fair housing law prohibits changing loan terms based on race, religion, or other protected traits. Advertising property only for certain groups, like no kids or Christians only. Refusing to rent a family with 6 children violates Fair Housing Act's protection against discrimination based on familia status. In order to ensure that future real estate taxes will be paid by a borrower, lenders may require a borrower to pay tax funds into an escrow account. An escrow account, also called an impound account, is a reserve fund where the borrower deposits money each month to cover property taxes, homeowners insurance. The lender uses this account to pay those bills on the borrower's behalf. The promissory note is a legal document the borrower signed promising to repay the loan. Title insurance protects the borrower from covered title defects, such as issues in ownership history, the chain of title. All right, this was 5 questions with their explanations to help you pass your national real estate exam. If this was helpful, subscribe, give us a thumbs up, and continue to stay tuned as we drop a new video every week to help you pass your national real estate exam.